Alrighty guys, good morning. I thought what I'd do is, I know a lot of you are asking about the closes and the S&P one last night, which I did come back for. Sorry, excuse me, I'll tuck my shirt in. So what we'll do, we'll have a look at the FTSE close, and in fact, actually, as the time on the clock here is 12 minutes past 4, we'll have a quick look at the bund close. Now, I'll be honest, I didn't trade this at all. I don't know if this is going to do anything, so this could be a disappointing moment for us all, but something might happen. With all these closes, and again, we'll do this in a little bit more detail in later weeks, with all these closes, it is entirely flow-based. You can't say it'll go up, it'll go down. You can have your historical bias, I think is probably the best way of putting it, in the sense that, as a general rule, good S&P closes and good FTSE closes go down. You rarely get the huge move to the upside on the close. It does happen occasionally, but in general, if you were going to have a bias, I've not statistically tested this, but I would have a reasonable guess that if you sold 2 minutes before every close, you'd be on side by the close more often than you're not. How far? Nobody knows. And the difficulty with that's perhaps a nice statistic. If someone wants to research it, go for it. The problem is what happens when you go offside. And so whilst you might be right reasonably consistently, when you're wrong for 20, 30 ticks in the FTSE, for example. So we'll have a look at the bund. I'll just play it from now. See how it trades. Bund at the time, sitting just around, don't mess around with everything. Good. Yeah, bund at the time, just approaching a little level here, sort of, what's that going to be, around 70s? So we'll see if we get any sort of pick up in activity in the bund. Not seeing much at the minute. Bund generally is like the last 2 minutes, and even then, when it took it bid, it was 52 lots that did it, so that's not exactly convincing. What you want to see is you want to see it take a price out and bid very quickly. And this, as you can see, traded 50 lots. There you go, 300 up, so that's not too bad. If you wanted to believe it, you buy 70s now. Trades 570, 71, 2. You see how it consistently takes the price out, and anything that trades back, it holds it. Now, what would worry me there is that did actually look like a flip. See where he builds up these 500, 700 lot, and then it starts trading into the offer, and the offer stays there. Nonetheless, it's still building higher, and that's perhaps the difference with this. If it is the move into the close, whilst it looks like a flip, what that serves to do is get people short, get people on the offer, then you can buy into it. So you're now seeing 1,000 chase it as well. So actually this bund close yesterday was pretty decent. It sort of showed you a bit of activity. That first bit where it took 68, 69 bid very quick, gave you the opportunity to go, okay, I'm going to buy 70. What we want to see now is if it does trade back down into this 700, that stays there. Come back bid, that's reasonably a good sign. So if you wanted to add on, you buy 74s now as well. You've got 30 seconds to go. This is where if it is going to go wrong, it can start to turn wrong with about 30 seconds to go. So at the minute, we've now probably got an average price of 72. And you've got the push out just above this level. So from a technical point of view, you could be slightly confident, but they are now just sort of taking it offered. You're not getting too much back up. 5 seconds to go, and we'll see if there's any sort of flick on the close. No, we don't get anything at all. So it started off as quite a decent close, that bund. The problem with it was that it just ran out of steam once it got up to 76, 77 area. You started seeing that as it turned back and traded back into the other prices, you weren't ever getting those bids really come back on it. And That's where it's difficult on a close, because you've bought 70s, you've seen it up here, you need to let it show you that it's not going to work before you get out, and by that point you're back down towards 73, 74. So not a fantastic close, but definitely something that I will watch out for today, because that did look like it at least got a little bit more energy into it. It started to move a little bit. So Bund close today, we'll all get watching out for that. This is where I kept trying to sell the DAX into the close, or not into the close, but into the S&P, taking out these 45s. It was a bit too much of a preemptive sell. S&P consistently got to 45, got whipped back up, 45, whipped back up. And that just meant that the DAX just wouldn't quite do it. I had a level in the DAX down at 55 area, 55, 53. I was looking to sort of preemptively get in and go for the break. Didn't turn out. There you go, S&P goes back down. This is what I was saying this morning about this sort of lack of, there's correlation but there's not. The S&P now is charging towards the lows and DAX is above where I originally sold it. Right, so let's move on to this FTSE close. Unfortunately, like I say, you guys don't have FTSE, which is a little bit annoying. But what you're looking for in the FTSE, I think, is probably one of the nicest examples of how a close should work. This one, again, wasn't a great one, and I'll show you why it wasn't a great one. But what you're looking for, a lot like the Bund, and you can watch it in the Euro stocks as well, just here. And as it turned out, the DAX was the one that really went on this yesterday. So what's a good idea is to keep your eyes on the DAX, the FTSE and the Euro stocks together. Because if they all start to go together, that often creates a better close. It's when they don't go together that you then get one of them starts getting held up whilst the others come off. And that's where the FTSE wasn't so good yesterday. You can see the DAX has now dropped from around 60s, we're down into the mid 30s. FTSE, we just, where's my FTSE chart gone? Oh, there it is. How convenient. There it is. Right, the FTSE basically has dropped from 25s down to 14s, so not a great deal going on. DAX is still down towards 30, so I'll step over this side and see a little bit better. And what you're looking for, to start with, you've got this 500 down here. Now, you'll see in a minute that I'll sell into the 500 because of the fact that, once I've got my clock right, because of the fact that it's getting close to it and it just can't move away from it. And I felt with the DAX breaking down, the S&P's done 5 more handles. If the FTSE can't move away, and now you get 100 on the offer, FTSE can't move away from it, there's a chance that it will just trade straight into it and straight through. They sell it, still won't bounce, and this I thought, yeah, we're going to go. 100 comes on the offer, fills him, and it goes straight up. And that's a bit of a price action trade that we'll look at in future anyway. It's called the hiding behind the elephant trade, and the idea is when he gets filled, you buy it just behind him, or you buy it as soon as it goes back above for that run up. So we've just had the little run up. DAX is still near the lows. S&P's bounced a little bit, and we're back up towards 17s in the FTSE. Now this is where now we're past 25 past. This is where, if you're going to start getting that pickup in volume, it's going to come around about now. So aim is to get short. You're looking for a bit of size to come on the offer. You're looking for that size to then, every time you take a price out, the size follows it down. So you've got 40s, 20s, 30s. What you want to see is this turn to a 30 lot now. See, it turns to a 30, you get another 30. That's where I'm happy to sell it. And what you should be watching for is where the bounce goes up to. So we're now bouncing towards 15s. So don't want to see it back above 15. Want to see some more offers coming in. Take the bid out and go offer. There you go, 30 again. So we keep adding to it. What I try and do is get one clip in, then add, and then later on you can try adding a little bit more into the last couple of minutes. So again, you're seeing these 30s come down. So it's another reason to add. Really, you could have your stop back up at 15 if you wanted to sort of go, right, I'm going to stay in this. DAX has now done 50 ticks to the downside. S&P's still only done its 5 handles. And so we're still seeing this sort of drop down, size comes back in, another opportunity to sell. What you have got to be aware of is levels. There's a level at 8. There's a level at 8 and a level at 3s.
Technical level.
Yeah, I do think they are important. If it's going to flow through it, it will break the levels, but you will almost always get at least a little bit of covering on the level. So we've still got 3 minutes to go. So this is a slightly preemptive position, really. You're seeing it come back up. What I try and do is, if it does start coming back towards me, is sort of reduce the size a little bit, because you don't really want to be sitting there. It can have a tendency that if it won't go down and other markets start to bounce, that it will rip straight back up, because everyone who's selling it here and not getting paid whilst the other market's going down is very quick to get out. So we're now seeing the size coming in on the bid. So I've given up on that one. But nonetheless, still can't get above 12s. So we have another go at 10.5s. And now you see those offers come back in. The offer's a little bit less clear on this, unfortunately. They get 100 coming in. Often what you will see is you can see hundreds that will come in and follow the market down. They'll sort of really chase it. Particularly into the last 2 minutes. The last 2 minutes where you really want to be watching out, you expect to pick up in activity. You see those 50s coming in once again. The problem here is they should be taking the next price faster and faster and faster, and that's what I mean about this not being a particularly good one.
Were you putting stops below there as it's taking out the price, it was putting you in more?
No, just try and hit market. No, I won't try and put a stop entry anywhere, just for the fact you don't know that it could just go filled and then ping you straight back up. Again, we're sort of pushing back up. Then the difficulty here was really what I should have done is when I first mentioned it, and looking back, this is something good for me to think about. That first bit of the move started up at 15s, and it never actually got back above there, and that was the level where that 500 got filled as well. So now you're coming into the last minute. This again, if it's going to go, it's going to go now. So we get short again, 100 comes in, and you see every time the 100 gets filled, that's not a great sign either. That's a sign that perhaps this isn't working, and really I'm kind of doing the wrong thing now and keep selling it. I'm really sort of trying to make a trade out of something that's not working. Clearly every time the 100 comes in, it's always getting filled and then not really continuing to come back. We got it again now, so starting to think, yeah, we could break those 03s, remember, was the level, and it can't do it. And you get through, and still it struggles. See, DAX has done another 30 ticks, and the FTSE's still struggling. You get 100 come in again, now you're into the last seconds, you get that final flick, and then we turn around. I think it then goes up from there pretty much. And the other side of the trade, and this is where I've been way too greedy here, is you get out, when it does that flick, you're looking to buy the flick down and put your stop below the low. And if you've done that on that flick down and got in at 1s, 2s, you're very quickly up towards 10s, 11s. So that was probably the best bit of the trade. And the clue from that came in the fact that the FTSE would not go down with everything else. They're clearly buying in it. DAX did a full 80 ticks to the downside in that final 10 minutes. FTSE managed about 15. Just wouldn't do it. S&P came off, DAX came off. So you can have a little bit more confidence in that reversal trade. And so you try the same thing in the DAX. And I think the DAX recently, whilst from a flow point of view and what actually trades through the ladder, the DAX I don't think is quite as clear as the FTSE. If it starts to go, the DAX does seem, particularly in the last few days, to really take its direction and go for it. So you have to trade the DAX from a slightly more technical point of view. But if you are trading the DAX, watch that Euro stocks as well. Euro stocks on this fall dropped from 80s down to 60s. So it's a 20 tick move for Euro stocks. 3 weeks ago, a 20 tick move in Euro stocks was a day. That was the whole day's range. It was dull, dull, dull. And so to do 20 ticks in 10 minutes is volatile for Euro stocks, as quiet as that market can be. But you probably see the flow in the Euro stocks a little bit better as well. The reason I don't massively watch is because I don't trade it. So yeah, today keep your eyes on stocks, keep your eyes on the DAX. Like I said, unfortunately you can't keep your eyes on the FTSE. What I'll do today is I'll clone my FTSE ladder and put it on the screen so you can see how that's moving as well. Hopefully we get another good close today, but that one was okay, but it never really kept the flow with it. Never really sort of took it offered and then held it offered and took it offered and held it offered. Every time you pyramided, it always came back. But nonetheless, if you took it from those 15s and went, right, it's not getting back above 15 now, I'm going to put my stop there and let it go. And this is something I was talking to Samir and Wakas about last night. With the S&Ps the same. Once it starts to move, if you get in early, as soon as you get a bit on side, you can put your stop virtually at a scratch and leave part of that move on. So sort of go, right, that's my position, I've got a whatever size on, I'm just going to let this go. Trade the rest of it like normal, but you know you've got whatever that position is and you're going to run it until the close, and then on the close put your bid in and get out. And I think perhaps on these bigger closes that we're seeing at the moment, it stops you doing that in out, in out, in out type trade. So yeah, that was the FTSE close. The S&P one I think was probably the most interesting. We can skip forward. Right, I obviously hadn't got to the office. I was currently driving around the diversions, which frustrated me a lot. Right, I think just about got into the office just here. Okay, right, so we don't have a chart up yet, so I'm nearly coming into the office. Then we'll get an S&P chart up. We'll have a look at how this trades. S&P was very, very fast, but I thought this did trade pretty well. Here we go. And to start with, and this is where it was almost getting too choppy to begin with, you needed to wait a little bit, let it actually show a proper bit of flow. This is the 845 spike up, and that's happened a couple of times recently. You get a push up at 845 and you can sell that. That's the one that Samir was talking about. Sell that and just put a stop in and just go, right, I'm going to leave that, I'm going to let it go and let it run to the close, which I believe he did quite nicely. I think he sold 15 there and then just left it to run to the close. But right, can I get the top? There you go, there's the clock back. I want to see that clock. So yeah, it's getting very, very choppy around here. Making a low down at 93s. I believe there's a level at 90s was the area that I was looking at. So my sort of plan going into it was, if we start getting through 90s going into the last couple of minutes, that's where I want to try and have a go at getting short, rather than try and sell it now, because really your stop's going to have to be up here, and that's a 10 handle stop, which you don't really want going into the close. So the choppiness is continuing, but what it's not really doing is pushing too much higher up the page. It's slowly sort of starting to dribble down. Back up to 93, so you're getting these 500s come in. And once again, back up to 94, back up to 95. So that was the first little bit of activity. You got 700 just came straight on the offer at 93s. That's an interesting clue there. It went straight to the 700, filled it, and it can't get back above. You see how they're coming back in and reload it. 93s once again, and again. That in a way is a little bit of an early clue. Okay, we start pushing back above it, so you'd be out now probably. And this is where sometimes getting a little bit too eager on the early part of it can almost get you in a bit of trouble. In that, you would have sold the 93s. It did reload it. It thought, I thought, yeah, that's probably good enough reason to have a go at a short there. In hindsight, I didn't actually do it. And then it gets ramped back up. So once I'm starting to see that, with 5 minutes to go, that it's quite happy to whip it down, whip it up, whip it down, whip it up. That's a sign for me that I'm not going to do anything now until the last 2 minutes, because of the fact that it feels now with that sort of up, down, that if you get in a position early, you're exposing yourself to a large risk that you're going to get caught out and lose money before the actual activity starts. And what you don't want is, if it is going to flow and is going to move properly, you don't want to be down and trying to get your money back when really you should be flat and taking the trade on for what it is. I'm getting back to putting my clock in the right place again. Seem quite particular about my clock. Right, and once again, this again is that real good example of how it starts suckering you in. We've been all the way up to 97s, and now it starts sort of really coming off quite quick, and you start thinking, oh yeah, maybe I should get short again. So it does sucker you in a little bit early on, which is why I've kind of mentally sort of said to myself, last 2 minutes really before I'm going to get too active. As you can see on the chart, it's just up, down, up, down, up, down. Getting down towards the low. Wonder if I get tempted to sell it through the low here. No, well done to me yesterday for not getting tempted on selling it through the low. So once again, it's done it again, straight up. What you did see there at 700 got filled just all in one bang. 700, I think that was down at 93.5. So that seems to be the area now. It's 93, 93.5. So that's where we saw the reloading before. That's where we've seen 700 come on the bid and he gets hit. There's still nothing really changing. You see the change when it starts to go. There definitely seems to be a bit of a change in activity. Also, volume's not really picking up just yet. We're getting like 15,000 lots a minute. It's highly respectable volume, but it's not really picking up. And it is literally a case of you're watching that clock. As soon as it hits 58, then I'm starting to think, yeah, something could be going on. Now you're getting it as the offers come in. You're not getting the bounce back up. You're not getting that sort of quick rush back up. It just seems a lot more stable now. And then you got that hit down. So yeah, that was the hit through 90s. 89s was Tuesday's cash low. So that was the bit that I thought, yeah, now we should really go through here. I'm surprised I'm not short it actually. Right, there we go, sold it through 89s. Because of the whip, I wasn't too happy about putting too much size on it. I'm definitely going to be willing to do a lot more tonight. And you see how it's not having that whip back up anymore. It's quite stable on the offer. So I managed to get short again, and consistently that it just keeps coming in, keeps taking the price out, chases it down a little bit. Yeah, you get the little flick back up, but not too much, and all the time that offer sustains, that offer comes back and back and back. And now you're getting 600s, 400s on the offers. Yes, they get taken out, but straight away, even with a little kick back up, they just come straight back on the offer. Now you've got 1300 on the offer as well, so that's a little bit more confidence. What I was really looking for was down to 73s. Now you've got another 1,000 come on the offer, comes further down. There you get 2,500. This is where you want to see, you get straight to market there. As he comes down, because he's chasing this down, he's come from 82s and he's dropped it further down. As soon as it starts to trade into that, you want to hit it, at least to get some of your position off, because chances are the market's moving because he's coming in on the offer. He's creating that extra selling where people are going, right, I really want to get in now. So everyone who sells at 81s, everyone who's now sold 80s, are all looking at this going, right, the second it trades, I'm going to give up on my trade because it's not putting me further on side. So the way I always look at the size is almost a reason to get yourself out rather than a reason to get yourself in, or in necessarily more. There's nothing wrong with adding with him, but the second it won't run away from him, you want to start thinking about getting out. So we've now got 20 seconds to go. Now with 20 seconds to go, I'm not really going to want to add too much more to the trade, because the fact you've only got 20 seconds, what you're looking for now is a further few ticks down, and then at 9 o'clock it should go ping and drop a few more handles. Target on here was those 73s, which is still a level today, in fact, I think. Yeah, it is. So the target I was thinking was 73, and the idea as it splashes down that you cut and reverse it. So the idea you just go, you have your bids in, and then you hit market as it spikes. So the idea is your bids will get whatever short position you're in out, and then you hit market to get yourself long, and it should flick back up. Should. Doesn't always. But again, it's a percentage trade. Generally it does. So you'll see he comes down again. I hit him there, so I've got rid of 2, and straight away it starts to bounce. You get another 1,100, and that gets hit again, and that's where people who are short are using that as a chance to hit. Now this is the point where I start putting bids in, and you see at 59 it should go straight down, and it blips, what, 5 handles up? And then I was silly. As soon as it did that jump from sort of 78s up to 81s, I should have been out straight away there, not give away the extra 3 handles that it jumped up to 84, because it's not done what you would expect. So you're better off to be straight out. But usually the trade is that it would have done an extra splash there, and you try and buy it at 73, 75 area. But that, for a close, was pretty decent. You see how quick that reversed, and that's the thing. If it had done the splash down, you'd be long 75s. It's trading 90s in a matter of, well, less than a minute. Didn't manage it, but you know, like I say, you've got to keep the trade for some parts of it. Yes, I ended up costing myself 8 handles on that bounce, but one, I'd got out of some into that 2,500 lot, and so that 8 handles cost like $800. It's frustrating, but if it had done the extra 3 or 4 down, one, that's not the 800, but it's another $300, $400, and the cut and reverse. So you've got to play for it. You know, tonight might be the one where it does do the ping and it goes 5 handles down, offers you that reverse and does this and puts you 20 handles on side in a minute. Now, that's probably one of the most extreme closes I've seen, certainly in terms of movement and speed of movement. What you didn't see much of in that, which is a more typical close, is a huge amount more size. Usually on what I would call a normal close, you'll see the bids and offers like 2,500 wouldn't even register. That would just be one of the other bids and offers. And then you're looking for things like 5,000, 6,000 if you want to try and get in front of anything. But the move won't be anywhere near as exaggerated. The move will be, there we go, it's over. The move will be 3, 4 handles. That's quite a decent type move. But I think the big thing with that was that as it started to go, it stopped that whippy action that it was doing up here around the sort of 95s up to double O's area, where it's getting very whippy that it would quite happily trade 92s and trade 94.5s like that. Once it got going, you didn't see that kind of bounce. It might come back a handle, and that was about it. So it is all about just watching how it changes, and the moment that started to change, that gave you the opportunity to go for it. So yeah, something I'll be looking out for tonight. Fingers crossed. It has been pretty much the same, or not quite exactly the same, but in terms of movement, it's been doing around about 10 handles on every close this week. Tuesday was the only tricky one because it started to go, and once it had come off about 5 handles, you got 2,500 came on the bid, and it jumped it straight back up and then chased it. So if you were very, very quick, you could have cut and reversed and gone long for that. That was the only sort of danger one, if you will, because you would have started to get yourself short, and then the 2,500 comes in, chances are would have put you straight back to a scratch, if not slightly offside, and then you've got to decide to cut and reverse. So that would have been a slightly tricky one. That's kind of the ideal type setup, where it picks up that sort of solid offer and then starts to drive. That's what you really want to see. So hopefully it'll set us all up for a nice Friday evening, but you never know. It could be very quiet. I think the key to it all is whether we get another pretty high volume, pretty high volatility day in the S&P. If we don't today, I'm not so convinced it'll be that good a close. I think it'll be much more muted, but I'm still going to come in for it just because of the fact that once it gets on this little roll of good closes, the S&P will continue it for a little while, at least until this volatility dies. So hopefully that S&P breaks this flag, which we've still got, and takes us lower. You can't get back above 13 at the minute, so it's not looking too bad for it. So yeah, if we can stay below here, particularly by the US Open, that has another go lower and takes out this low, takes out yesterday's low, which was down at 78 on that close, something like that. If we can take that out, then we've got no more lows on the cash chart, and that I think is what will get people starting to worry. Yes, there's lows down here on the futures, but the cash session, no one's seen it down in these lows, and that I think could get us really going. So get that flag to go, get those 73s gone. I don't really see why it's going to go back up, and you could end up seeing a a proper sort of panic into Friday afternoon, followed by then the Monday. If, like I was saying this morning, and for those of you online, I was talking about August 2015, and the fact that on the Friday you got a sort of attempt higher that failed, dropped into the evening, Monday morning came in and Europe didn't buy it, and that was the difference. Whereas this week, when you got that drop down, Europe bought it straight off the bat on Monday and Tuesday morning. Didn't get that on that one in August. They tried to buy it and very quickly it turned over, and as soon as it turned over, Europe then dropped, which has not been happening. This week, generally, Europe stays quite stable, and at the moment we've not seen a great deal of activity. Yes, we've got slightly bigger ranges than normal, but we're not seeing huge swings, particularly volatile, fast movement. You're just seeing general trade, but with slightly larger ranges, and then it goes in the US session. So again, that US session I think is going to be very telling today. Like I say, personal point of view, in terms of bias for what I want to happen, I want this to go. What could happen if we start getting back above 13s, then I think you're looking back up towards these lows, which are coming at 45. I should move that trend line really, which I can't quite do with the, yeah, there we go. Yeah, I think back up towards 45s if we can break through 13s, and then that I think would be what would cause a reasonably quiet day, because you're just getting back into this range here where the market's traded a fair bit. It doesn't need to break it out to the upside today. It doesn't need to break it to the downside today either. So I think, yeah, we could end up seeing a little bit more of a subdued, rangy type day in the S&P if we do manage to start pushing much above these 13s, particularly by the US Open, which, it will still be a big range, compared to what we were getting 2-3 weeks ago, whereby your range was 15 handles on a day. You're still likely to see a 30-40 handle range day, which is still pretty big, and might just subdue volatility enough to make it a little bit more readable. So at the moment the S&P is not particularly readable. You've more got to go off a short-term chart, go for the break, go for the level, whatever you're going to trade it off, and sit with it and just trust it. And that seems to be sort of the strategy, more than try and trade exactly what you see on the ladder until the close, because everything in the middle of the day looks a lot like that 5 minutes before the close, where it's just up, down, up, down, up, down, up, down. It really chops you about. Anyone got any other thoughts or anything else they're trading today, just before we move on? Quiet morning. Yeah, I think not a bad choice. What's everyone traded this morning?
I
Just not traded. Fair enough.
didn't have any.
Yeah, call it managing energy.
Yes. Waiting for the afternoon.
Yeah, it might not be too bad an idea. Yeah, we've not really seen anything particularly interesting. Buns have been.
Yeah, there was one certain ones, I think, the longest.
Yeah. From the. I think I know what you mean. Very similar trade to yesterday, actually. This is something to watch out as like a repeat type trade. And this is a trade that Nick's a big fan of. Where you got yesterday, you got these lows down here at 26, and you got 4 lows in a row, and that's the kind of thing. I said this to Wakash yesterday, and he was like, that's the kind of trade that traps you in all day long. That everyone, because he's traded the low so many times and not gone, you expect the low to break. And so what happens is all of this little range, which is 1, 2, 3, 4, 5, 6 candles, so half an hour of range, you just get people trying to get short, get short, get short, get short, in the expectation of this breaking. What then happens is, and this is, like I say, this is what I call Nick's trade, is as soon as it breaks out of this little range to the upside, everyone here covers, so you actually often will get a faster move to the upside against it. And this is that one I was talking about yesterday that me and you had to go at, Tom. And I was, like I said, I was quite happy because we're in a downtrend. I was quite happy to take the break and a little pull back to 48s. But that's, you know, reasonable little distance to go. Just catches out a few shorts. As it turns out, we did nearly a point to the upside. But yeah, with any trade, take your target for what it is. That was my target. I was happy with that. Otherwise, you run the risk of either not getting out when you should or becoming hopeful on a trade. And if you didn't really have a target, you'd be up here and then you wouldn't really know what to do with it. And if it was going to turn back, you'd still get stopped out in the same place. So yeah, be happy with the trade that you've got. But was this the trade you were talking about, Victor?
Yes.
The break up of 83. Yeah, it's almost exactly the same type of trade where it gets people short thinking that those 71s are going to break, and yeah, totally blows everyone apart. And I was looking at this in terms of, we'd been back down there, and what I was looking at is, you see you've got these smaller little lows just around 77s, these few little candles here, and it was the break of those where you got that slightly quicker move down to 71. What I was looking for was to move back there and hold below. If it had stayed below 77 on the pullback and then started to go again, that would have given me the confidence to try and sell it through the low. But the fact that it just jumped straight back above 78, you could almost have got in early on the move through 78 and played that effectively smaller little block, which would have shown up on a 1 minute, like a very little block. You trade it back through there, get long there, preempting the break to the upside. And also, the other reason why that was not a bad trade is the close was still up here. And that was something that I think was always going to get traded, because the fact we opened in range from yesterday and the close was within the broader range, the close does usually get filled. So there was always that was sort of hanging over the bun that was perhaps going to stop it really extending. Now, with the fact we've gone back up, traded it and come back off, now if we go for those 71s, might be a better chance of breaking. Because you effectively got some position in one way that's not working, you then see that positioning unwind as we go back through the low.
So will it be now 71s or 70s that you will be looking to?
Ooh, tricky. I think I'd still be looking at 71. I would expect 70 to be the point where it just goes. I don't know how much traded at 70. I don't think very much. Yeah, 21 lots traded at 70. So I wouldn't necessarily call 70 the level. Effectively, what could have happened there is someone sold one, and that's hit someone's stop for 20, and it's gone bang, and someone's got stopped out there, and yeah, that happens, and no one else has sold it there. So yeah, I'd still be inclined to look at 71. What I would really like to see is it come down into this area again, into these 83s, and do something a little bit like this, whereby it bounced and then created a little range and then went. And so on this attempt down, if it does this down to if that low 71 again, and it does this little range, you've got this little area here to try and get short in if it breaks this little block. So say basically it does this pattern again, that's the area on the break of this little block, try and get short. What it then gives you is it will put you 4 or 5 handles on side by the break. That's where you can then hit the low with a little bit more confidence. And of course, it might not work. You might sell the low and it will go 69, 68, 69, 70, 71, 2. Didn't work. But the fact that you've got in at 74, 75, 76 area, you'll probably get a scratch, which isn't all that bad. You know, you've taken the risk on. Whereas if you don't play that way and just sell it here, so you'll probably sell 70 and it goes 68 straight back up, you're guaranteeing yourself a loss basically. So it's different ways to take that trade on. The preemptive one, you're getting in when you can't guarantee it's going to go, but minimizing your risk in terms of how it comes back. Or you go for it on the break, but the onus on being right is so much greater if you go for it on that break. But it does give you a nice opportunity to pyramid it.
And from the first one, the next trade, right, at the bottom over there, so 26s.
This one?
Mm-hmm.
Yeah.
So you would enter on the breakout on 39s, right?
What on this trade here
Yeah.
for the upside? Yeah, that was my trade.
And if it didn't, if it didn't go well, would you cut it then?
I think I'd cut that pretty much as soon as it dropped back into the range, 37s, 36s.
That's,
Because the idea of the breakout is it should put you on side quite quickly. It shouldn't. It's not really a breakout if it starts trading back. Because what's then happening is you're just finding more sellers. Breakout, you should find sellers giving up on that trade, and it's starting to run higher.
on the next candle, it went down to 36s. So
Did it go 36?
yeah. So it was probably sort of borderline.
Yeah.
Almost on the.
Yeah, I'd be interested to look at that on a 1 minute. Perhaps it could have been that it didn't get in on that one, and it was as it went through it. As it went sort of, because that made a little spike up at 39s. Let's have a look. Get on a 1 minute.
So you sort of spent 3 minutes over there trying to get through this level.
Yeah.
Yeah.
Yeah, I'm trying to think where I got in on this. I think I did get in at 39. It could have been the fact that whilst the highs of the little range is 39s, most of the highs are at 37. So once it's got up and then can't get back below this area, then you want to get in on the break. That was a slightly trickier one. It might have been that because of this, I was willing to take a slightly larger stop. I can't remember at the time exactly what my thought process was, but it was definitely to buy it above 39. And really, the first time it properly pushed above, and actually I've traded through 40, it did go. And then 48, so I thought was quite a nice little target, on tops of these little highs there. And as it turns out, it was a nice target, but we just kept going. And that moving average, again, helping out a little bit. It's a little bit ropey in the bund in terms of it dropping back through it and then staying back below. I like to see that move a bit faster, so when it comes back, hit and react. I think it works a little bit better in quicker markets. One market I think it works particularly well in is cable, and I'm also noticing the FTSE does as well. DAX works quite well after a big rally or a big drop. So one very straight line move, the first comeback, it seems to work.
And then coming back to Victor's trade, so he went in on the break of that was 83s,
No, I didn't trace.
Oh, you
Today?
Yeah.
No, I didn't trace.
How about you sort of quantify that was your idea?
Yeah.
Okay, so coming back to the trade, so 83 is on the break, and then because of this, these two weeks that you mentioned, and 77s, you had this tighter area. So is that somewhere that you would be looking to cut if it went against you?
Oh, what? So this what we got there. You got like 77,
Yeah.
and that was the breakdown. So that was the bit where you're thinking this could go. Like I say, you could have bought it back above 77, and that was this little bit here, and then sit in it, and that's where it gives you a slightly nicer trade compared to buying it above 83. But you could have had a go at buying it above 83. Yeah, it comes back, puts you in a little bit of trouble. You then get a second go, and often, as we saw in that previous one, it's that break of that next high. So we went 83, 85, and then as soon as the 85s went, because 85 is a point where on the break of the little range, it found a bit of selling, goes back up and breaks it the second time, and there's no selling, and that's almost your confirmation for that move higher. So it's often quite tricky on a chart in terms of what exactly happened. So I don't know whether this was literally like 83 and it went flick 85 straight back down, or whether it went 85, traded it, came back off, traded loads in here, which would have definitely sort of got you doubting it. But yeah, it does look like once it started the move, it then accelerated. With the Bund as well, what I find is once it starts to go, the first 3 or 4 ticks, it picks up a little bit of speed, and then it struggles for a bit. And that's the point where anyone who still fancies a sell is still there trying to get the sell away. And then once it gets through, that's when you get this sort of acceleration as people finally throw in the towel properly. Whereas to start with, you will get people selling this and then try and average it a little bit higher up, either to try and get themselves a scratch or to try and basically play the false break, which I think is a bit of a danger trade, but it is a trade that I've known people doing in the past. I know someone quite a few years back, he was in Samir's trading group when I first started. Oh, sorry, well, when Samir first started even. So years ago, when things were in black and white. Sorry, that's a bit harsh. Maybe it's not that often. Whose trading strategy in the bobble was basically to have bids and offers 2 ticks behind every level. So the idea is that as a level broke, you get filled, and at the time in the type of markets that they're in was often working quite well because they weren't particularly volatile. You didn't get a great deal of range extension. But as soon as that stops, as soon as you do get more volatile markets, breaks the level by 2 ticks, it will then break the level by 5 as well. So the one trick pony element of it dies off a bit, like I say about that guy who started just after me who had the Euro trade. And yeah, if you don't realise that something's changing, you will lose on it. And it's same principle goes on to those closes as well. If you realise that it's not working the same today, you should give up, which is perhaps what I should have done in the FTSE yesterday. Stop trying to sell it through the low because it was not going, it didn't want it. So always sort of think about it, is it really doing what I think it should do? Right, so final bit of this week, capital markets. We'll do bonds in the afternoon, we'll do equities just now. Look at main things that affect equity markets, and we'll have a quick look at the VIX and what that's been doing recently and why I think this time could potentially be slightly different. So we'll have a look at that in a sec. There we go. Right, whole point of capital markets, and I imagine you guys probably all know this, I think particularly Victor who worked in a bank, gets it all. But essentially, the whole point of capital markets is basically just to move money from people who've got excess to money to people who have a deficit. I.e., if I've got lots of savings, they go in the bank lends it out to someone who wants a loan to buy a new car. And that basically is how it all works. The only thing is it saving and borrowing, or is it investment and then sort of taking on new capital in the basis of companies? And the whole point is it's a risk exchange as well. If you're saving your money, you don't want to risk it too highly. If you're investing your money, then you do want something that offers you at least a little bit larger risk, and also you want some kind of return on that. Yeah, there's no point in you saving money and basically funding someone else's business if you don't get any return on it, because that's what you're doing when you save money. Put it in a bank, you are funding their businesses effectively. So, right, quick look at who's involved. You got lenders. Basically, all lending comes from individuals or companies, in that they use their profits, their earnings, and that all goes into a bank, which becomes an intermediary, pushes it out to other people. They're the intermediaries: banks, insurance companies, pension funds, mutual funds, basically anyone who takes your money on. Capital markets, we'll talk about the money market and interbank market a little bit later on. We'll let Victor give us a run through on those, seeing as he's the expert. Otherwise, main capital markets, stock markets and bond markets. Bond markets generally perceived as lower risk markets to be in, unless you're in the European debt crisis, which they definitely weren't. And then stock markets is what we've been watching predominantly this week, and that's where companies trying to fund expansion, fund new business, fund acquisitions, and the whole point of them selling their stock is that they can bring in that extra funding without taking on borrowing. In terms of borrowers, companies, governments, municipalities and individuals. Governments, municipalities basically form bond markets. Companies, you do have corporate bonds, but the majority of companies' effective borrowing comes from issuance of shares. Also, in terms of the use of capital markets, individuals are not going to be a major part of it. There's not many individuals who are going to use capital markets to fund any of their future trading or business, apart from some very, very, very wealthy individuals. George Soros, someone like that. Right. How it all works. Effectively, you get a transfer of ownership, or you get a transfer of money with the promise of getting this money back. So, company point of view, company gives you ownership partly of the company, which exposes you to further risk, and then potentially a dividend. Not all companies give you dividends. Banks in recent years have pretty much stopped from giving dividends from sort of 2008-9. I think that started to come back in a little bit more now, but there was very much a crackdown on dividends for a lot of banks. So effectively all you're getting then is just risk, but the point of that risk is your capital appreciation in a company should theoretically be greater than you would get in a government. It's rare that you're suddenly going to get a major desire to own the bonds of one government over another, for example. And what a company gets, they get extra cash, so they can use that for purchasing whatever they intend to be doing with it. In terms of bonds, so corporate or government bonds, effectively the buyer gets a set interest and they get security in the fact that the bond is backed by a government, which essentially can guarantee the money back, because ultimately the government owns everything in the country. So if they really had to pay it back, they could take over all the land in the country, they could enforce taxes on people, etc., etc., etc. So theoretically you don't hold a great deal of risk by owning a government bond. We have seen defaults. Argentina seems to love a default. They did in 1998, and they did in 2002. Don't know if they've done anything more recently than that. Russia also defaulted in 1998, which brought on the LTCM crisis, long-term capital management, where they got themselves massively over-leveraged in certain positions, which with the Russian default all got pushed apart. Basically, they're effectively playing spread trades with massive leverage, and once Russia defaulted, all their spreads blew out at the same time, and because they all go at the same time, they can't get out of the spread either, because there's no one willing to take the other side of it. So they end up in a very illiquid market with an enormous position that they can't move, which led to effectively a government-sponsored bank bailout of LTCM. It's a really interesting story. If you want to go and read it, book's called When Genius Failed. Really, really good book. It's got a fair few trading principles in it, in terms of the idea that being so convicted about how a trade can work out and so sure that it can't possibly have any black swan or external impact is perhaps not something that you want to be doing. You always need to consider those sort of black swan type events. And just the idea, in a sense, you bring it back to trading, that effectively what they were trying to do was take on a major risk to make a very small profit, but the theory was that that profit was 99% probability of being achieved. Problem is, your 1% when it blows up, blows everything you've made. So in terms of an equity curve, it grinds up, drops the whole lot in one. Not dissimilar to what the S&P looks like in the last week or so, but not necessarily the greatest sort of strategy, but that is a strategy that a lot of prop firms have gone down in the past, of having a lot of spread traders, and the theory that you basically play the spread. If your spread goes offside, you just average further into it, and the idea is every spread should be mean reverting. Not always the case, and the problem is when one spread doesn't, often other spreads won't as well. So they'll all go together, and one, you can't get out, and two, you're so far offside because you're offside on both sides of the spread that's the end, basically. From a prop shop point of view, it's quite a nice model because it gets people doing a huge amount of round trips, which generates revenue for the prop shop, which is great until they all blow up together, because generally they'll all blow up on the same day together, because most people are probably in the same type of trade. So yeah, interesting sort of book story on how it all works. All right, so quick look at how companies actually get their stocks sold, how it ends up in public hands, and how we can actually trade it. Effectively, a privately owned company wants to raise capital. Now, what they can do, they can either go to individuals and give up part of their company, a bit like Dragon's Den effectively, and take on some smaller investment there. Or you take the company public. Now, the big advantage of taking a company public is, one, it gains credibility by being on an exchange. Most people don't necessarily know of many companies that aren't public companies. What it also allows is you to sort of move that risk out a little bit from yourself personally, and it provides an ongoing scorecard and a little bit more incentive to improve the business, because the shares trade more freely. Your running of the company is shown up more directly in the share price, whereas if you're a privately owned individual company, you don't get that ongoing judgment of the company. So that sort of like group view of the company, it's more just your individual personal view of it, and your company's worth is whatever percentage you can sell to someone effectively. Furthermore, if you float your company and the share price goes up, it allows you to then borrow more money because effectively it increases your value. And so borrowing against a company worth 20 billion, if you want to borrow 100 million, doesn't seem very much. And that's because your share price has been pushed up. In terms of privately owned companies, I'm pretty sure this is true. Someone can go and check this out for me if you want. Bono from U2 apparently made more money off buying Facebook, so investing his money prior to Facebook going public, than he did in his entire music career. And just investing in Facebook. Lucky for some if you know the right people, but I don't have Mark Zuckerberg's number. Right, so how the shares get into the public domain. Basically what happens is, if you've got a company, you want to sell it, you go to a bank and you say, right, we want to sell X amount of our company, so we want to give up this many shares. The bank then goes around, speaks to clients, and basically guides the private company as to what price they can get for those shares, given the valuation for that company. The bank then effectively goes, okay, here's the money, we'll take that on, and then it's the bank's issue to sell the shares. So that's the primary market. Those shares then go out to, are generally sold to other clients, and that's how they then end up in the secondary market. So you go primary first to the banks who underwrite it. Once those shares are sold, they're in the secondary market. They will be on an exchange, and they can be freely traded by anyone, companies, funds, speculators, whoever wants to trade them. You do get dual listings as well, whereby you get companies list certain numbers of their shares in one stock market, certain number on another. For example, Royal Dutch Shell has a listing in the UK and in Amsterdam. A lot of other companies have what's called ADRs and IDRs. What's an ADR stand for? It's a depository receipt. So basically the idea is it's almost like a synthetic product based on the company that can be then traded in other markets. So you will get ADRs on UK companies that are traded in the US, thereby giving you a sense of how those companies are traded overnight. So that's how you get onto exchanges. Like I say, they could be on multiple exchanges. So we'll move on to the actual indexes. The idea with an index is an attempt to give a broad view of a country. Get it out, it's Friday. Which is and isn't always the case, as I gave the example of the FTSE the other day. That it's not necessarily a view of the country, it's a view of those individual sort of sectors. And so understanding the types of companies that make up different indices gives a little bit more of a broader view rather than the country itself. For example, FTSE is made up predominantly of mining, mining raw material companies, banks, pretty much is what the FTSE is all about. So whilst yes, theoretically that should give a good view of the UK, there's very little mining that actually happens in the UK anymore. So it's not so much a view of the UK, it's a view of those companies' earnings worldwide. Each index effectively is whoever creates the index's decision on what's in there. I think that's a mistake that people often make in thinking that every company in the UK is in the FTSE. It's obviously not, it's just 100 companies. So they'll each have a different number of stocks and a different method for calculating value. The majority of indices are market cap weighted. Things like the DAX have a sort of slightly hybrid market cap weighting that takes into account a couple of other things. I think it does take into account price, but effectively it is market cap weighted. The only big difference, does anyone know which one it is that's price weighted? Yeah, Dow's price weighted, which I don't see the point in a price weighted index, particularly because you only need one company to go in with a massive share price and then it's irrelevant. For example, if you put Berkshire Hathaway into the Dow, they'd be about 99% of it. Because their share price is something like $250,000 a share. So you put them into the Dow and you wouldn't be trading the Dow, you'd just be trading Berkshire Hathaway. So incidentally, companies that affect the Dow may or may not have such a big impact on the Nasdaq or the S&P, which they're also listed in. For example, biggest companies in the Dow are companies like Goldman Sachs and IBM, who neither of which are in the top 10 in the S&P. IBM top 10 in the Nasdaq, but not the S&P. And Goldman's isn't even the biggest bank, and yet is still the biggest company in the Dow. So that's where I have issues with Dow always being quoted as like the stock market. It's just the fact that the numbers are slightly higher, I think. Like I say, know the industries that are important to your particular indices. For example, DAX as well is not particularly bank heavy. DAX is a little bit more chemical and tech based. So DAX does have a little bit more correlation with the Nasdaq perhaps than the S&P sometimes. It's a little bit more likely to get pushed by that, whereas Euro Stocks is a little bit more broad in what it's got in it. Still, Euro Stocks is quite focused on banks, and particularly banks in Southern Europe. So you've got things like Santander, you've got Intesa Sanpaolo, you've got a few of the Italian banks in there, which does mean that then the Euro Stocks will be quite skewed by banking issues in Europe. So understanding that, so whatever index you trade, you do want to understand the companies that are in it, the types of sectors that are in it as well. What's also worth knowing, or sort of keeping a good idea of, is what the biggest companies in that index are. So for example, DAX, you're looking at people like Siemens, Bayer, BASF, Allianz. The other big sector in the DAX as well is autos, because they've got BMW, Mercedes and VW, which are three of the biggest companies, auto companies in the world. If you take out Tesla, which is now the biggest auto company in the world.
Market cap.
Yeah, market cap wise. Which we had a good debate in the last group about Tesla, because Clark doesn't see why Tesla should be so valuable, because ultimately they don't make money on their cars. The counter argument to that is Tesla is the biggest producer of lithium batteries in the world. So if that becomes the new big thing, Tesla in a way isn't a car company anymore. It's a tech battery company. So that's the other argument for why it's so important. Other things also to be picking up on, and you'll pick up on this anyway, just like in the media it will come up more and more, but any stocks that are in play and sort of the stocks that are getting focused on. Recent one's been FANGs, or you can actually have FANGs with a double A. And that's Facebook, Amazon, Apple, Netflix and Google. And they generally have been the stocks that have pushed a lot of the most recent rise, particularly 2016-17. They've been the ones that have really benefited. Amazon's share price has gone through the roof in the last year or so. And a lot of this has had to do with US tax policy, because of the fact that Trump allowing these companies to repatriate funds from abroad with an effective amnesty on them getting taxed means that they could bring a huge amount more capital back, and so increase spending and expand their companies. So they've all benefited from that. But yeah, that's been the big sort of in-play group of stocks, so being worth watching. And in fact, I had a quick look at this earlier. Apple said that they were going to cut production of iPhones, and that was the 29th of January. You look at Apple's share, you look at NASDAQ at that point, that was the second highest day on this move when they said that. So basically, Apple cut production, Apple shares have dropped since then, they've continued to fall, and that basically called the high of the NASDAQ. I'm not saying that's the reason for this fall, but it's things like that that could perhaps at least get you a little bit bearish, and so perhaps have had you turn the right way for this. Yeah, I still don't think that necessarily you're going to be able to call this and stay in for the whole thing, but perhaps gave a little bit of a clue. All right, so sector correlation as well. We saw this quite a bit in 2008. You saw it all in 2000, and I've got a little example of German autos. But effectively, sector correlation occurs where you get certain companies get driven lower by the sector as a whole. 2008, it was all about banks, and so what you end up with was a lot of decent banks getting driven down by the fact that all the other banks were getting pushed down. Good example in the UK, Barclays. Effectively, there wasn't a great deal wrong with them, but everyone else dropped, so Barclays share price dropped. You saw the same with Ford in the US and Chrysler and GM getting crushed. Ford's share price dropped through the floor. You can look at that, and in hindsight, they're the kind of companies, if you did want to trade individual stocks, that's where you want to be actually trying to buy it. Likewise, internet companies in the early 2000s, anything that was .com just got bought and ended up with a massive valuation. It's like we've seen recently, and they've tried to crack down on this, companies changing their effective naming or principal business to become a cryptocurrency company, and you've seen their share prices rocket recently. Not exactly morally correct, I don't think, but they've been getting massive valuations for it. So you do start seeing this, and you start seeing these themes that go through markets whereby the focus all shifts to banks for a while, the focus all shifts to cars for a while. You got this a little while ago with the emission scandal in VW. So what you got is VW shares got slammed because of the them failing an emissions test in the US, and so the thought was that they're going to stop being able to sell cars in the US. There's going to be lawsuits, etc. What it does, it did bring down BMW and Daimler as well. They got dragged down with it. You then get VW falling down to the lows. You get 2 class action lawsuits announced in the US. And then what happens, often with a lot of things like this, the peak bad news can often be the low, because the fact we already kind of know it's bad. The share prices come off, we're down 40%, and then what happens is other manufacturers get investigated in Germany, and from that point what happens, BMW drop, Mercedes drop, VW gets bought, and effectively this is a spread trade whereby VW news is bad enough. Now down at these levels, you've got a greater expectation of BMW and Daimler getting dragged lower by this than you have VW going any lower. So you get this spread trade back where VW gets bought, goes from 40% down to 20% down, and by the end of the year, BMW and Daimler basically stay totally flat, whereby you got they got sold, VW got bought. So effectively, that had the impact on the DAX of actually being a bit of a buy. Once you finally got that full bad news out, you then get the turnaround. So market does price things in before it happens, so do keep very aware of that. And yeah, it was, to start with, I do recall on this sort of when that first bit came out and the other manufacturers were getting brought into it, There was definitely quite a heavy quick sell in the DAX on that, but it turned around very quickly, likely because VW getting bought. All going VW, they were the ones that got ramped on an options trade as well, which I've not got the chart on here, but I'll try and find it for you, back in 2008. Okay, so index correlation, generally they all move together. You know, take equities at the moment, they've all dropped off together. But it all depends on what stocks are in play, what the themes are that are going through the market at any one time. Like I said, I gave you an example, Eurostoxx and Eurostoxx banking index, which if you want banking index on TT, if it comes up for you, if FESB. So they do a futures on all the different indexes for Eurostoxx. So you have FESA, FESB, FES, blah, 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 blah. And that was for a time having a reasonable impact on Eurostoxx and was actually something you could follow and gives pretty good indication of where highs and lows would be in the Eurostoxx based on the Eurostoxx banking index. This has since, and you'll notice this with equity markets, they just stop worrying about things after a while. There was lots of fear about Deutsche Bank coming towards the end of 2016. This kept creating worry in the DAX. The DAX would move on comments about Deutsche Bank. Deutsche Bank shares drop. There was a risk they could go bust. And then people just stopped worrying about it. Deutsche Bank shares haven't massively recovered, but people have just almost forgotten about the problem, and this does happen quite a bit in equities. They shift on to the next thing quite quickly. Watch out for individual sort of countries versus regions. So FTSE versus EU equities, you got massive outperformance after Brexit, you got big underperformance during QE. So whatever the stimulus is, you know, that's where the correlations break down when it's quite specific to certain countries. You've also got the currency correlation, which I'll show you in the FTSE. Effectively, you've got DAX chart, FTSE chart, DAX chart, and a quick look at what happened with QE and what happened with Brexit. So QE pushed them both up. FTSE broke its highs, this was 6,200, and went up 300 ticks. DAX broke the equivalent highs and went from 10,000 up to 13,000. So you got a 3,000 tick move in the DAX, you got a 300 tick move in the FTSE. All because of the fact that, you know, QE is obviously more European based. I do recall a time not all that long ago, I think 2010, where FTSE and DAX traded the same price. DAX has a tendency to be much more volatile than FTSE. So if the DAX drops, it will drop. And that's where it has sort of dropped back towards FTSE levels. In the past, I think it did in 2011 as well, get sort of online with FTSE. DAX definitely seems to have the greatest volatility and the greatest degree of overshoot on things. It gets a little bit carried away with some of the stuff that it gets going on. But then you see the pullback on QE, they both effectively pull back to about the same price, the same place, you know, back to where they started. It's just the FTSE's move up was nowhere near as violent. And then you get Brexit. DAX just about breaks the recent highs. FTSE double the move through recent highs. So it is all down to what exactly it is that's affecting it and the region that you're in. Likewise, the US is the biggest beneficiary of the QE to start with, because it was a US thing. US companies went first, and they're the ones that kept going. Just wanted to highlight currency correlation. It's not always that prevalent, but in the FTSE, since Brexit, the currency correlation has been quite impressive in that almost tick for tick, particularly on data and pieces of information, FTSE and pound will move in opposite directions, almost tick for tick. You can almost trade the FTSE just off what the pound does. And this all started since Brexit. You've got the rally in the FTSE, but not so everyone knows about the general rally in the FTSE. It's more the bit about sort of all of these individual little drops. So you get the pound break these highs, causes a FTSE drop down there. Again, every time you then get the pound pullback, you get the FTSE rallying back higher. It's not, perfect mirror image, but the general gist is there, and you will generally get this theme, particularly on a news type event or a fast move in the pound. You can trade the FTSE straight off it. So knowing your levels in the pound is very important if you're trading FTSE. So if you see a decent level in the pound, you see it break that level, you can almost, if that level say to the downside, you can almost buy the FTSE and play the breakout trade in the FTSE. So you don't have to be a cable trader to trade cable effectively. Not seeing that quite so much in other markets. We had a stint of it towards the end of last year with the European equities and the euro being very, very inversely correlated. And that did actually at some point spill over into the bunds as well, particularly when it's monetary policy related. So watch out for those currencies. And with everything, particularly in equities, it all comes down to what the current theme is. So that's been a theme for about 18 months or so. Although recently this drop, the big drop we've just seen, FTSE's come off, pounds come off as well. So perhaps we're seeing that start to break down a little bit now. You also saw it on that Bank of England yesterday, that the FTSE didn't really come off when the pound rallied up, and certainly not as much as you would expect. So perhaps this correlation is falling apart a little bit, and perhaps it is now a little bit more of a dollar focus type thing, that is that dollar strength that's one impacting the S&P and then also bringing the correlation into Europe. So it's more the FTSE's reacting off dollar and its impact on the S&P than it is to the pound itself. Alright, so next big area that you want to be looking out for, any company actions. These create quite nice ad hoc opportunities. You obviously don't know when they're coming, but out of the blue you can get a nice bit of news. Someone is going to buy someone, as long as you know their positioning in the index. Good example, if you get some news that someone's going to buy Heidelberg Cement in the DAX, probably not much of a trade in that. You might get a tick, but yeah, Heidelberg Cement, one of the smallest companies in the DAX, so no one's going to worry too much about that. Or ThyssenKrupp, who make escalators. I found that out recently. I've always known that ThyssenKrupp were in the DAX. So what do they do? And it was only when I was in a shop recently I looked at the name on the escalator. They make these. Excellent. Generally, as a rule, the company that's buying, their shares fall. The company that's selling, getting acquired, their shares get bought. What usually happens, and most of this usually comes out as a rumour to start with as well, which makes it better because the fact you get a couple of chances to trade it. You get the rumour, you get the official, and then you often get a bit of a denial as well. Share price will gravitate towards whatever is the quoted acquisition price. Often it won't quite get there. Reason for this is merger arbitrage. So what people will do is you will sell the company that's getting bought, buy the company that's doing the buying, on the basis that that deal will fall apart, and that way the shares will come back. So you get that spread coming back. And because the fact you've been given an upper limit by the price that they're going to acquire them at, your risk is reasonably limited, because they shouldn't really explode too much higher than that, unless you get another bid comes in from a different company. That's the sort of risk on that trade. Like I say, big thing with it is entirely unscheduled usually, which then means you have an edge because you can react first to these things. It's not likely that you're going to have a load of algos all plugged in to every piece of news from every company. So if you're on it, if you see it, generally you could be the first to react. So it gives you really, really decent edge there. Next things to watch out for, company buybacks. Reasonably important, but a lot of companies have been doing that recently. They've got a lot of excess cash. They're buying their shares back. Effectively, what it's a way of doing is using up their reserve capital. A company that's seen as having a huge amount of reserve capital not doing anything can be deemed quite inefficient, and for that reason you could actually see their shares dropping. So effectively by buying shares back gives their share price a boost, at least short term, and is also a way of getting excess cash off the balance sheet. Dividend increases, decreases. Another thing that was becoming a bit more of a theme a little while ago, but this seems to have dropped off quite a lot. What you'll also hear with the FTSE as well is you will hear of companies going ex-dividend. What that means is it's a period where if you buy the shares during that ex-dividend period, you will not be eligible for the dividend on the next quarter, for example. So creates a sort of very short-term lack of demand for shares. Dividends aren't paid by tons of companies. A lot of it is that major oil companies generally pay dividends. A lot of the more sort of mining raw material companies pay dividends as opposed to perhaps banks and autos. They're the companies that are often held a bit more by pension funds, mutual funds as well, because they offer a return. So that's becoming less of a big theme at the moment, the company sort of share buybacks and dividend increases. It will come back. All of these things will at some point come back and start being important once again. All right, quick example on company interest, and this was the sort of rumour mill type thing. What the rumour was is that Bayer, who are at the time were the biggest company in the DAX, they're still top 5, were going to buy Monsanto, which is a US agricultural pesticide company. Rumours that they're going to buy, you get Monsanto shares gap up, hold for a couple of days, then continue higher. Bayer shares drop. Now the importance of this and what you need to take from this is there's no point in trading Monsanto, i.e. there's no point in trading the S&P on this. Monsanto are not a big part of the S&P. Yes, they're a reasonably big company, but they're not a big part of the S&P, whereas Bayer, being the biggest company in the DAX, does actually push the DAX price down. So you're better off to be short DAX than trying to buy S&P, despite the fact that that's where the buying's going on. What you then get is the bid was confirmed. So this was the rumour initially. You then get a bid confirmed at 122 for Bayer shares, and that's where you then get this secondary gap up and rally. We get up to 113, and Bayer shares continue to fall. So like I say, you get two trades. You get the first trade on the rumour of interest, you get the second trade on the bid, assuming that Monsanto shares haven't already got there. If Monsanto shares are trading 120 and they bid say 120, 122, I'd actually expect Bayer shares actually to come back up, because they're not necessarily spending any more than Monsanto's currently worth. The expectation is Bayer's going to take on perhaps a lot of debt to fund this kind of purchase. So that would be the way to look at it. So if you do start hearing any rumour of companies getting bought by other companies, get their share prices up, get to know exactly what their shares are doing. It becomes impractical to know the share prices and have a chart of every company and every index. It's just not realistic. So as soon as you get the news, then start having a look into it. All right. Another example, and this happened within a day, and you will often get this, that the index will have a trade halt if there is a big piece of news coming out. So you got Nasdaq trade halt relating to Broadcom, which is share ticker symbols AVGO. Don't know why. So you get often, particularly in the US ones, Nasdaq is halted pending news. So you know something's coming there. You then get Broadcom proposes to acquire Qualcomm for 70 a share, cash and stock. So what you get is big ramp up in Qualcomm shares. You then, later on, this was the day before. The next day, Broadcom explores deal to acquire chipmaker Qualcomm. Comes as a source comment on Bloomberg. No, sorry. That was the other way around. So effectively, that came the day before that Broadcom may acquire Qualcomm. That's what got this ramp up in Qualcomm shares. You then get the facts, and then you get the sell-off back down. Despite the fact we got up to 65, and then you still get the sell back, because everyone who went on that sources comment buys it, holds on, and as soon as they get the fact, they're like, right, yeah, I am right. Take your money. How much more do you want to sit in this? You've taken the main bit of the move. So that's what you do, often get that counter move on the confirmation of a rumour. All right, this was Kraft wanted to buy Unilever. And the point here is about understanding relative size within a index. So Unilever is listed on both the Euro stocks and the FTSE. Unilever is not such a big component of the Euro stocks. So once this news came out, you get decent buying in the FTSE, which if you look at where the open was on each day, FTSE takes it straight back through the open and continues much, much higher for the rest of the day, up 45 ticks. Euro stocks does go up, but we only get just back through the open. So the importance there is understanding which is a bigger component, because the fact it's listed in both. The reason it's listed in both, Eurostoxx is an index, just like the FTSE is. So whilst Unilever shares only trade on LSE, they can still be listed in Eurostoxx. Eurostoxx just takes an index of all the shares within Europe. So you should probably know that Unilever is a reasonably big part of the FTSE. When you hear that, it's a FTSE trade you want to be taking on. You don't want to be taking on a Eurostoxx trade. One nuance in the FTSE or UK stocks is if a deal doesn't go through, S&P's broken that flag. If a deal doesn't go through, you then can't have a counter offer or a secondary offer for 6 months. So if you do get any of these deals, note it down if the deal doesn't go through as to when 6 months is going to be, when you could potentially start hearing news. So whilst you may not get any more news, you at least can be planning for it or thinking that it could happen. All right, quick look at the FTSE close, and a real shame I don't have the replay of this for you. This is what happened when AB InBev bought SAB Miller. So SAB Miller is a UK company, despite the fact that SAB is South African Breweries. UK company. What happened on the last day of their trading is you got a pump up in their shares. So the reason for this is they were going to be taken out of the FTSE, and also they were no longer going to be a company because they'd be absorbed by AB InBev and traded on a different exchange. So what effectively happened is their shares got pumped up into the close so that people could take profit on the shares that they owned when they got sold. So what this effectively had the impact of doing was pushing the FTSE futures up. So you got this grind up of about 30 ticks into the close. So that was right into 4:30, and then as soon as it closed, so effectively the SAB Miller shares were taken off the exchange, you then got all of that basically artificial buying to bid up SAB shares into the close. All of that was gone, and you then got massive selling. You saw 500s, 800s come into the FTSE and chase it down. So that provided a huge opportunity. This drop in 3 minutes was 80 ticks. And that was basically all because of SAB getting pulled out of the FTSE. So it doesn't come around very often, but the final trading day of companies on a certain exchange, if they're getting acquired, focus on the close on that day, because if it does anything like this, it's very readable. If you expect it, that move up was very, very easy. It was slow, it didn't do much, but when you got in, it put you on side and it didn't really ever come back to you. So it sort of drifted up, final push into the last minute, and then you could sell it, and it went the other way. And once it started getting down into this area here, that's when you really got the selling coming, and it absolutely hammered it lower. So make sure you know if any of these instances are coming about, because the opportunity on the close is often very, very big. All right, earnings. The only companies that we really focus on are US companies for earnings. Reason being, the majority of EU ones come out pre-market, so you don't often get too much opportunity. You rarely get HSBC, and occasionally Shell may report just after 7 o'clock. Other than that, there's not a great deal. Glaxo is the only UK or FTSE company that reports in the middle of the day. They report usually around about midday, so that's about the only tradable company for European stocks. Nokia, when it was in Euro stocks, because it was the biggest component, was a great trade. That was one that you could trade the Nokia around. It's a bit like Apple, so at the time Nokia was the biggest phone company in the world. No longer, and they've been bought by Microsoft now. US earnings, on the other hand, come out between midday and 2 o'clock, and then you get aftermarket for tech companies, which can be a little bit tricky to trade, but if you do stay for it, you can have some pretty decent movement on some of those. The thing with earnings, again, a little bit like unscheduled news, you will often get a range of time that it will come out in, or an approximate time. So you can then be ready for that, knowing that your chances are you're still going to be one of the first to it. So yeah, midday till 2 o'clock generally. What I tend to do at the moment, earnings aren't really a big deal, because there's no real crisis going on. There's no major worries going around. But what is a good idea to do is take a note of each company's time that they release. So whether it's 46 minutes past the hour, 58 minutes past, etc. That way you're a little bit more ready. Whereas most people go, oh yeah, McDonald's reports at 1 o'clock. I noticed that actually they always reported at 12:58. So everyone's waiting for 1 o'clock. You're ready to trade it at 12:58. And you're likely then to be the first person in. As I say, at the moment, earnings aren't playing a major part. You know, when they do come into focus, you can trade virtually all of the major US companies. When I say that, I mean like McDonald's, Coca-Cola, Exxon, GE, all of the banks, there's a lot of opportunity. And yeah, they're not always going to be massive, but it might give you 10 ticks. And if you can have a go at making 10 ticks on 3 different earnings every day for earnings season, you can do a lot of your day's work just by being prepared for that. At the moment, as I say, it's not such a big deal. Tech companies are having a reasonable impact. This was Apple's earnings for Q4 last year, and this was their impact on NASDAQ. Oops, I've got a lot of drawing all over this. This is their impact on NASDAQ. So what we ended up doing, we moved from 62.35 up towards 62.55, so a 20 handle move on Apple earnings. The tricky thing with Apple and the tech companies, particularly the ones that produce things, well, and even the Facebook type companies, you will get numbers on iPhone sales, so that beat the number of units. Revenue increase, so you want to be watching out for unit sales, revenue, and then their EPS, which is earnings per share. That's generally the main number. And what you will often get is you'll get an EPS number, you'll get a diluted EPS number, you'll get an EPS X items. The X items number is really the one to be watching for. That's the one that takes out all of the one-off charges, things that aren't quite as ongoing business. So that's what you want to be watching out for. So first up, this is where you could have got in on the trade straight away, that their sales went up in terms of units. You will also get a revenue estimate as well. So they will often give you a forward-looking projection. And in this instance, actually, you got Apple seeing a Q3, Q1 revenue dropping, which perhaps explains why you then got the Apple shares. They got pushed up whilst the NASDAQ was shut and then reopened and came back off. And that is likely to do with this revenue impact. The other thing, when you read this on Reuters, be very careful of that phrase that says share view. The share view is what the estimate was, not what the actual was. So you get share of 207 and revenue of 52 billion. Share view was 187 and revenue of 50 billion. So that's the other bit that was the big buy opportunity. So you get the opportunity on the unit sales, and then it was confirmed there, and that's a reason to stay in the trade. Likewise with someone like Facebook, it will be active users that you're going to be focusing on, and then revenue, etc. Like I say, the only unfortunate thing is it's aftermarket. Now, US equities have a closed period between 9:15 and 9:30. So what can happen is you wait for Apple earnings, NASDAQ shuts at 9:15, Apple releases their earnings at 9:16, and the NASDAQ just goes gap, and that's it. So you do run that risk that you won't actually get the chance to trade it if you stay for it. So it's your choice on whether you really want to stay for these type of things. Personally, I feel that it's not that worth staying for, just because the amount of information that comes out, you've got to judge all of that and make a decision quite quick post-market when it is very, very thin as well. So I feel that the risk element to it is perhaps not worth staying for, and the risk that from a sort of like personal energy point of view, do you want to be sitting here at 9 o'clock possibly to do nothing, to still come in the next day? So more the middle of the day earnings I do find are perhaps the slightly better ones. Right, one quick look at VIX. which has been sort of the big impact that we've been seeing recently. And I know it's always said that it's a volatility indicator. Personally, I don't think it is. It is very much a sign of fear. You rarely see the VIX going up, even if you have a volatile up move. So it only seems to go up when you get falls. Now, what's been happening in the VIX is falls in the S&P have been creating less and less extended moves in the VIX. As you can see, quite nicely illustrated by this very nice downtrend which broke this week. But every dip in the S&P has created a bit of a bump up in the VIX. As soon as the VIX starts to drop back, that's when the S&P then gets brought back up. And that's been a theme of the last few years. If we go and have a look, nice little chart. So what I was trying to illustrate here is the relative sort of weakness in VIX reaction to these things. So you get Chinese devaluation, where you got a huge amount of volatility. VIX got up to 53-ish. You then get January 16, further Chinese devaluation. VIX only gets up to around 30s. Brexit, we don't even manage 30. US election, when the S&P went limit down, didn't even get us above 25 on the VIX. So what's generally seen as a point where you're going to get a bit of volatility, a bit of sustained selling, is somewhere over about 20. That's sort of a bit of a sweet spot. 20 to 30, if you can sustain around there, you should see continued volatility for a period of time. When I say volatility, likely continued falls for a little bit. Historically, in terms of levels that you can get up to, 2008 crisis, we had the VIX up above between 50 and 90 for about 2 months. So you had this sort of level of volatility for about 2 months, virtually every day. You then got European debt crisis, we got up to around 50. 50 since then seems to be the peak of volatility. So I'd be tempted to say this is about as volatile as we're going to get. I don't think we're going to get much more. But we shall see. If we get a VIX close up here above 50, we could be setting up something very, very big. So keep your eyes on that VIX, where it closes. You know, you can look at this as you would look at any other chart. And if it starts to close over certain levels, you're likely to get a bit of a move. I pointed out last Monday that the VIX actually closed above 17 for the first time. The first time since last year. We closed above 17. We got that close above there, and then we got the surge higher in the VIX. So you can look at it from that point of view, that you get a VIX close, and that's confirmation that we should then see a continuation of volatility or falls. Now, part of the reason for this VIX drop of late is the what's called risk parity trade. Now, the idea behind a risk parity trade is, as the S&P comes off, VIX spikes up, you sell basically a volatility option, or a volatility option structure, effectively, because the VIX is it's to do with a ratio between put call options on S&P futures. So as the S&P drops, you get into a VIX trade which tries to drive the VIX lower by the S&P, and what we've been seeing on all these recent drops last year, you pretty much get one solid down day followed by a consolidation, then gap up. Again, drop, that one pulled back within the day, another drop, consolidation, gap up, drop, consolidate, gap up, drop, gap up. And that's been the theme. And that's where this one was slightly different, that you got a little push up in the VIX, made a little flag, broke this trend line, and then closed up above 17. And that was the difference, that usually you would then get the gap back up and we'd rise. But what happened is, as soon as it got up above 17, we then got that massive sell-off on Monday, and that's what really sort of got the market going, got the VIX up. So there were clues there from the VIX, so keep your eyes on that. If you want to watch a live price, it might be easier to get XIV, which is the inverse VIX. So it's basically a flip chart of it. So XIV should fall with the S&P. But I know it's a product created by Credit Suisse, who were the other day talking about potentially stopping using it. So yeah, that's the risk parity trade, and that's perhaps why we've seen such a dramatic fall, because that trade's got quite crowded, so everyone's having to get out of the trade together. And so I think that's probably the reason behind it. We are going to have to wrap up because it is 5 to 12. If anyone's got any questions on risk parity trade, keep them for the afternoon and we'll have a little chat about that. But yeah, I'll wrap up. Darren's stream's on now, so I will see you guys just around about 1 o'clock. Right, see you guys online in a little bit.